Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action. All right, today we've got Sam Eddinger with us. He's with Ironclad Property Management out of Connecticut. Sam, thanks so much for coming on the show today. Can you just give us a little bit of background and tell us how you got started in real estate and how you found your way here today?
Sure. So how I got started in real estate, my father was a shop teacher, a middle school shop teacher, and he never understood the stock market. So he ended up using all of his extra money to buy houses. And so I saw a man on a teacher's salary with 5 kids and a wife, my mother, who never worked a traditional job, acquire a multi-million-dollar real estate portfolio. A lot of the things that I like to believe, one of them being buy until you die, comes from my father. He's only sold 3 properties in his life. One was to me, one was to another friend of the family, and one was a really bad part of our state where his tenant actually got shot and killed in the front yard. And so my father just has never sold property. And people now say that he has the Midas touch. And he never bought good. He always bought bad, doesn't understand what a cap rate is, doesn't know what cash on cash means. Used to say things to me like, Sam, if I only need to subsidize this $300 a month, in 30 years, it'll be paid off. So he did everything wrong, but now being 30, 40 years removed from when he started doing it, now everyone thinks he's a genius. So that's how I got my start, continued, I became an engineer. Did that for about 15 years, was disenfranchised with my engineering company. Prior to that, seeing my father do it, I started buying real estate back in 2012 and continued buying it through today, still looking to buy, flipping now, doing things like that. Quit my job in engineering in 2018, started this property management company, and the rest is history. How I got to find you guys, we have some common acquaintances, and also I'm looking to eventually get into the syndication game, so I figured you guys were some good people to meet and to get to know a little bit better.
Awesome. Yeah. Thank you, Sam. Excited to have you on. That sounds pretty similar. Not completely similar, but our dad also was an investor, and he really made his name doing contract sales. So he would do rent to own, and kind of had a little bit of a bleeding heart when he really wanted to provide housing to people who couldn't get loans. And AJ and I kind of saw that and we're like, but very, very interesting and funny how we kind of all wind up in the same place in NARPM together and in EO. So why don't you tell us just what is interesting you right now? And what's making you want to get into syndication, and kind of what led you to get to this point?
Yeah, so I currently own 20-something properties. I made a goal for myself. I'm very goal focused. And I made a goal that by the age of 40, I wanted to be able to retire. And I had said that I wanted to have 30 properties. And for most people, that's like this crazy goal. But I'm very goal driven. Age of 38, I guess 36, I quit my job. I'm 42 currently. Been doing this property management for about 6 years. By the age of 40, I was not at 30 properties, but I owned about 50 units. And so I kind of say it's a wash. And I was able to retire if I wanted to. And so the problem that you guys may or may not realize, I'm sure you do, is when you end up having 20-something properties, your Schedule E, the taxes, all of it just, everything gets more and more complicated just because you have more and more properties, right? It's like, I got to keep track of all of these different income and expenses on this one family, on this 2 family. And then also when I turned 40 and I was able to retire, I kind of got a little bit depressed. I was like, well, I hit my goal. So now what? And so that's a lot of where EO came in as well. It's like, what's my next thing? And I decided to double down and say, okay, by the time I'm 50, I want to have 200 units and I want to make somewhere around $200,000 to $300,000 in gross rents per month from those units. And so if I think about it from going from about 50 units to maybe 200 or 300, it's really, really, really difficult to go ones and twos. So at that point, I need to find bigger buildings to buy. So syndication becomes the logical conclusion of that.
And, once you get to about, sorry, AJ, go ahead.
Oh, I was just going to say I'm not sure if all of our listeners know what EO is and NARPM. Do you want to explain those two organizations so that some people have some background?
Yeah, sure. So NARPM's the National Association of Residential Property Management. So it's a great organization. A lot of people that want to share. Our industry is really filled with people that want to share. I think what happens when you're in property management, which you guys, the audience, don't probably realize, is it's a lot of people being unhappy with you for things that sometimes you can control, but most of the time you can't control. And so it's owners, it's vendors, it's residents, it's all sorts of people. And so the NARPM community really does two things. One, they support each other because we know how hard this game is. And two, they share best practices to allow you to become better as a property management company, to try to eliminate or reduce as much this stress and pain that you have in property management. EO, Entrepreneurs Organization, is an organization that was founded by Vern Harnish, I think, who's one of the preeminent kind of thought leaders on development and growth.
He wrote the book Scaling Up, I believe.
Correct. Scaling Up. Yep. And so he basically, so it's a not-for-profit that ultimately helps entrepreneurs have support system, because any person that is an entrepreneur, especially a CEO type level, knows how lonely it is on top when you don't really have someone that you can go to for answering questions and getting guidance. And so a lot of people, when you get to a certain level, to try to get to the next level, you need to find a tribe of people that can help you get there. And so EO is great. It's local. So I'm in Connecticut. They really care about us, and we kind of can build in each other with shared experiences.
Well, so the question I was going to ask was, once you get to about 20 units, you mentioned retiring, but I guess AJ and I found that once we got so many units that we actually had just made a job for ourselves. And so I guess at what point, I guess you could third party everything out and really go hands off, but that's pretty difficult to live off of, or at least what we were, when we had 12 houses, that was kind of the point when we decided to go pro. Did you run into a similar, I guess, conclusion, or do you feel like you're retired?
No, I work a lot, right? I think the concept was more optionality, right? I had the ability to retire if I wanted to, as opposed to the desire to retire ultimately. I was third partying it. I was starting to buy in 2012. I was still an engineer. My brother actually owns a property management company in Connecticut too. We compete and cooperate. He tried to coin the term co-opetition. And so what's interesting about all that stuff is that and I think you guys realize this, and probably your audience realizes this too, when you first buy property, you're not really going to make much, if any, money. And the reason why is because either there's a lot of deferred maintenance that you have to deal with, or you got to stabilize the rents, or interest rates are high right now, and you've got vacancy and bad debt that maybe wasn't done. A lot of if you look at the T12s that I see, maybe it's an owner operator who is his own handyman still, and he's going in and he's not really booking the labor costs. So there's a lot of that type of stuff that ends up making it so that the returns, at least for the first few years, is not as good as you would expect in a cap rate or a pro forma. And so the same thing happened to me. I was buying back in 2012 these single family homes, and I was like, well, if I only need to make $100 or $200, that's fine, because I was expecting appreciation, right? My brother said I was an idiot. I think I ended up proving him wrong after 10 years that actually the appreciation game, I was buying in 2012 before the BlackRocks were buying. And I told my brother, I said, you can't build a house for $80,000, yet I'm buying a house with land for $80,000. I said that it has to continue to go up. And he's like, no, it's Connecticut. There's no appreciation. And I agreed with him. And I said, but it's a theory that I had, and I was living with that. And I said, I'm going to buy these properties and then I'm ultimately going to sell them 1031 into a 3-family, and then have the cash flow there. But you take it 10 years from now, some of these properties that I purchased for $80,000, $100,000, I was getting $1,300 a month in rent. Now I'm getting $2,300 a month in rent for a single family. So now I'm getting great cash flow on these as well. And unlike a lot of my peers, I never refinanced, because I was like, look, I'm doing this when I'm 30 years old. 30 years from now, I'll be 60. I don't want to be continuing to pay these debts when I'm 70, 80 years old, right? So I decided strategically that I wasn't going to refinance, wasn't going to take all that equity out. And so I'm actually under leveraged. I'm at about 50% leverage, or debt to income was about 50%. I own some in cash. What I also did was, because I buy a lot of small multis, my wife and I have about 18 loans, Fannie Freddie. Figured out how you could do it where I could get 10 loans and my wife could get 10 loans. And she wasn't working because we have 6 kids as well. So ultimately, she wasn't working a job, but I got her 10 loans, all because I learned how to play the game well, and did some things strategically. So I don't even remember where our question went, because I can meander all over the place. But yeah, it's, stop there for a second.
Yeah, there's definitely that limit of 10 loans per individual name, which is awesome. One thing that Chris and I did differently is we re-leveraged properties about after 5 or 7 years, and then took that capital and just bought more property, which is it's been great. It certainly is able to fuel the purchasing power. And then also what we found too is, when we first started out, we were like, we've never seen interest rates so low. The run of interest rates at those low levels was incredible. If you can make 7% in the stock market and you're paying 3% on a mortgage, like, it just makes sense to take the cash and just know that we know where to put it someplace better. So we opted to re-leverage those properties every chance we got. Obviously, there's a cost associated with that, so we wouldn't re-leverage it for a couple grand. But I mean, if it was upwards of 50 to 200 grand, like, that would be an opportunity that's worth paying that $3,000 to $7,000 to refinance. So
yeah, agreed. And what's interesting about that is, and I will completely admit a couple things. One, I say this is an embarrassing fact of me, which is I've never lost money in real estate, right? Which means I didn't try hard enough, right? I wasn't pushing hard enough. I wasn't doing what you guys were doing ultimately, and continuing to re-leverage, right? Because if you're not embarrassed that you lost money, then you should be embarrassed that you always made money. You didn't do it hard enough. But the other thing about it is, you're completely right. I have friends that own bigger apartment buildings, and every 3 to 5 years, I mean, a lot of times they're arms that adjust anyway. So just go ahead and just do the appraisal and refinance, and that's how they made all their money, was cashing out that money, and there's no tax ramifications of it either. So it's just a blessing. So with me, because of the fact that I was doing these 30-year notes, like, for me, it was more about, when I'm 60, it'll be paid off. And I understand that's not for everybody, especially people that want to lever. Like, at this point where I'm 42, I probably would do 15-year notes on anything that's 5 and below, or 4 and below, I should say. But if I did syndication, I would be re-leveraging. So this building that I purchased, this commercial building, I think we have a 5-year arm on it. And when we've been doing a whole bunch of money to improve the value of it by renovations and raising rents, and I'm going to pull every dollar out of it when I can, because you kind of have to, right? So it's a different game when you're doing it for me at least, when you're doing small multi versus when you're doing bigger deals.
Yeah, I mean, the difference is the small multifamily is based on market value and what is it, the sale value, whereas like when you're doing multifamily, it's all off NOI.
So market approach, income approach.
Yeah, it's a couple different ways to approach like what the property's worth. And again, like you said earlier, it's like learning how to play those games. And once you learn how to play those games and you know how to pull the right levers, you can come in and you can do that. But that's one of the benefits of investing with someone that's done it before, right? Like being able to come through and say, you know what, this guy's, he knows the things, knows what to do. I mean, Chris and I can talk about like one of the first syndications we did. We actually like screwed it up. We we made kind of a blunder. We hadn't done a lot of commercial loans.
This actually cost us a lot of money.
This did cost us a lot of money.
Syndicator.
Yeah. So we found a property for 1.2, and the appraisal came in when we bought it at like 1.5, 1.6, and had a ton of deferred maintenance. So we put a hard money loan on it, and we picked it up, and like in 3 months we had all the stuff fixed up. We knew what to do. We had it occupied, and then we went in for a loan. Well, turns out that on commercial loans, it's not like a residential loan where you can just refinance out to the market value and get LTV of 80%. They held us to loan to cost. So it was our purchase price plus whatever we could prove we put into it was the max that they would loan us. And so we'd already paid all the fees to get the appraisal and environmental and everything else associated with it. And like we were sunk, and we wanted to get out of the hard money loan rather than dump all those fees and then wait another 6 months to redo it. So we've learned that.
We should have dumped the fees and just waited the 6 months. We would have gotten a better appraisal in a year. This would have been up. Like we ended up getting like a 1.1 million loan when we could have gotten like a 1.6 or 1.7 and essentially returned all of the capital for our investors back. And so that it would have been, like an infinity IRR.
Yeah.
And, that would have been a 50-50 split based on our waterfalls. But we didn't do that. We kept the investors' money. And now it's basically an 80-20 split. Well, it's like an 87-13 split because of the preferred return and price or sales prices are down, and so it's a rough lesson to learn.
It's a lesson, right? It's and anything else. It's like how do you get your education, right? Usually you have to pay for your education regardless, and so I try to learn from other people. I try to learn from other people's mistakes, right? I talk to people all the time. I'm like, don't try to be like creative with like your syndication JV structures or whatever. You're like, see what people do. There's a reason they do it. Don't try to reinvent the wheel, right? And so I always go into situations and I'm like, all right, I need to learn something. So learn like seasoning requirements, like you're talking about, right? So that that you can get all the money out because it's based on true appraisal, not cost plus, and all that other kind of stuff. So, but there's a lot to this game, and so understanding and how to navigate it is really an important part of, be it the syndicator who's doing it, or be it the property manager who's doing it, be it whoever. It's it's not easy. It's not for the faint of heart.
So I'm going to kind of maybe change the subject a tiny bit, but there's a fair amount of like other operators and investors that listen to our podcast. And I think they might have some interest in kind of like you said, you created a property management company in the last like 6 years. I know a couple other operators that are thinking about, pulling property management in-house. Like, do you want to talk about the benefits? Like you are the owner, and maybe you haven't used other third-party managers, but like maybe let's talk about some of the benefits of having, the benefit of being vertically integrated, essentially, of being able to manage and control the employees that do the management and control the property management for your own properties and assets.
So the benefit for me as the owner?
Yeah.
So the benefit for me as the owner is I get to do only the things I want to do, right? So I'm not like, I'm talking to you guys while today is the 30th and my guys are running around doing move-ins, right? That's the benefit of me being able to control the staff is I get to basically I get to pick and choose the things that I want to do, right? Ultimately. And that optionality is really important for me. So, I like to think about it from a perspective of what are the highest value activities that I can do? And then how do I teach and train and outsource the things that either I don't like to do or are lower value activities? We significantly leverage remote staff. I have 7 employees international. I have 5 local, including myself. And there's a lot of benefit to being able to develop a really great property management company, both for the owners and investors, as well as for me as the owner of the company, because you can provide a better service, with better people that are doing all of the administrative functions internationally, because we can leverage technology in a big way at this point in 2024.
What were some of the challenges of like setting up the property management company, and like kind of like, I'm assuming that you had to go through hiring employees for the first time in the last 6 years?
Yeah. So this is where I think I indicated to you in the introduction that my brother owns a property management company as well. So I incubated underneath him. So at that point, I'd owned 30 or 40 properties. He had decided that he wanted to get rid of strategic investors because they're more price sensitive, and he really wanted to focus on accidental investors. And so there was people that he was thinking about firing anyway, because he couldn't figure out how to get enough income to justify the cost, all of the expenses. And so I was underneath him, and I leveraged his appfolio. I leveraged, all of the systems and processes that he had built over the preceding 5 years. And then ultimately, we split off about a year and a half later. So I didn't have a lot of the pain that a lot of other ones do. With that said, I do have a check that I write to him every single month when I bought out his 50% interest in the company. But I do that willingly and happily, because it did allow me to really get past a lot of the introductory growing pains. So he had already been leveraging remote staff a little bit. He showed me how to build an LLC, how to make a website, who to pay what for what, systems like Gusto and accounting softwares. So he was really instrumental in kind of getting me accelerated in that beginning. And that's, I know, unique. Most people don't have some property management company that they could go in and talk to with the express expectation that you're going to spin off a competitor. But my brother did it willingly and lovingly because he loves me.
Wow, that's very lucky. And awesome too. It's great to have a brother.
True.
I don't know if you guys are part of a bigger family. I actually have 4 brothers, no sisters.
Wow. No, it's just the 2 of us.
Just us.
Yep. But you have 6 kids?
Yep. 3 boys, 3 girls.
Oh my gosh. That's crazy.
And so that's and talking about, back to your question about like having the ability to run a company, and me saying about doing it my way. One of the things my wife challenged us, we're having our 20th wedding anniversary next month, in less than a month. And this summer, we're going to go on vacation for about 6 weeks to drive across the country. Right. And so I'm like thinking about like, what are the things that I really needed to do? One of the last things I needed to do was to get a stamp with my signature on it. So I can have my ops lead actually sign local checks. Right. But most everything that we have and do can be done remotely. I don't see my staff most of the time. We're all remote. The reason why we have an office is for keys. Right? I like being in here because I compartmentalize. When I'm home, and I don't think about work. When I'm at work, and I don't think about home. So, so we're trying to take all 6 kids and my wife to drive around country with our Chevy Suburban. So it's going to be interesting.
That's going to be a crammed car for sure.
Yeah. So I don't know how you take I don't know how you take 8 people in any car and it not be crammed though, right? Even if you get like a Sprinter van or something, like driving all the way across country, things are going to happen. So
how old are your kids?
My oldest is 15, almost 16, and I have twins that are not in Connecticut, but she's actually, one of the things that we're doing, we're holding off our date so that it's past her birthday so she can get her permit. And then we're just going to have her be not a third driver, but we're definitely going to like allow her to drive some and gain a lot of experience driving across country. So, and then I have my youngest twins are almost 8. So I have from 15 all the way to 16, almost 8.
That's awesome. I have an 11-month-old, and it's a fun journey.
Well,
definitely is.
I'm going to move this conversation on to syndication. You said a couple times that you've been interested in that. Like, maybe tell us kind of what sort of research you've done so far, and like what you see as the benefits of it, and why you want to get into it.
Yeah, so the benefits of it is that it allows you to leverage a lot of money relatively easily and efficiently in an asset that you know, that I know. That's one thing. The second is that you can make it passive if you're on an LP. You can make it active if you want to be on a GP, right? One of the things that I like to talk about is, and you guys can probably attest to this, most syndication arms are a deal finder and like a demographer, and maybe you have a third person. But I never see a traditional GP that has a property manager as part of the GP, meaning not even the property manager doing the physical managing of the property, but just as a property manager as an oversight person for it. Because I know what is good property management and I know what is bad property management. And so like there's so many property managers that will do these syndications all throughout the country, and they're not very good, right? And so if you have a GP partner who has property management experience, you can help them, those property management companies, to become better than they would be without that experience. And so I've always talked about it with, I want to be on the GP because I want to be able to provide that level of value. Whereas maybe I'm not the money finder, maybe I'm not the deal finder, but I can definitely add a lot of value. So, that's one of the things that I want to do. One of the other things I want to do is I think I've explained that my property management company is extremely systematic. I actually believe that if I go into like a syndication type situation, I can possibly, if I think about it well, can actually utilize my property management company and software and systems anywhere in the country. And so I've systematized it enough, especially being in a blue state, that I can go into a red state with pretty good expectation that I'm going to be able to manage there, because blue states are a lot more tenant friendly. And so if I'm able to do that well, then going into a Texas or a Florida should be a lot simpler. There are changes in laws that you have to recognize, but I think that that's also a benefit that I'm looking to do in the future, is expanding my property management company through syndications or joint venture.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
What are some of the hurdles that you see kind of getting into syndication?
Yeah, so for me, the big hurdles are right now, because of how high interest rates are, you haven't had the cap rate compression. It's a 7 or 8 with a 7% interest rate. So it's hard to make the numbers work, especially if you're doing a preferred return. So that's one of my biggest hurdles. Another one of the hurdles is an understanding of all of the changing laws with respect to fees, tenant fees, what can be charged, what cannot be charged. Because a lot of the benefit that I have as a property management company is that I'm able to realize additional revenue over other people. So that's one of the hurdles that I would have. The other hurdle is you do still need strong leadership. I think you could do a lot of the stuff remotely, but you still are going to need to have some ops lead over top of one of these people one of these remote staff that are doing all the administrative functions for the syndication. But you also need to have boots on the ground. So the way that I look at that is you got to have a good, handyman type person that can also function as a field inspector, can put lock boxes on it for self inspections, can do a lot of those functions to be able to make sure that you can continue to operate efficiently. And I think you probably would need a little bit of a higher level, handyman type person. One other thing is a lot of what I'm trying to do is be able, like we talked about before, is be able to refinance and get all of that equity out, right? If I'm able to operate the syndication at, let's say a 1% management fee instead of a traditional 5 or in 5 plus all of the reimbursements of the cost. If I can do that at 1, like that drops right to the bottom line, right? And so if I can do that, then presumably I can refinance it, take all of that extra, net operating income that I've received from from efficiently running it, and then be able to make the return through the refinance. One guy that I spoke to said that it's a different model, right? Everyone always assumes 5 plus, payroll reimbursement. And so a lot of the banks might not actually accept that as a means to justify, giving us the higher return profile. So that's a challenge as well. So there's a few things I'm kind of waiting patiently to see, the election, to see, I believe that there's about to be a pretty big commercial issue with all of the non-performing commercial loans that are coming due in the next year to two. And so I'm looking to see,
you're referencing specifically like office commercial.
Yeah,
retail.
office commercial. Sorry. Yeah, not residential. Industrial and residential are going to hold up fine. The commercial side is going to be in a world of hurt because people work from home a lot more. And a lot of people had bought these with a 3% note that's now transitioning to a 7%. So there's just not you can't make the numbers work on a DSCR basis without bringing a lot of cash to the table.
Yeah, I mean a lot of downtowns right now are 20 to 50% vacant in the office, which is
I had heard something that like for most situations you have to be about 90% occupied for you to be able to hit your DSCR ratios. So that was before everything happened, right? So people were buying these elevated prices because the fact interest rates were so low, and now it's coming due. So, I'm curious what happens with the our country, and whether or not they stimulate again, or whether or not they let those companies fail, let those people fail that have bought the commercial space. I don't think you're going to be able to retrofit much of it, so that's not going to bring an affordable base on the market. But like for me, I guess my point is if that failure occurs and what they do is Jerome Powell turns on the money printers again, I'm buying, because all they said is I'm going to reinflate that balloon, right? So at that point, I'm going to buy because housing prices and everything else and rents are just going to keep going up.
Sure. So I think kind of what Chris asked was like, what are some of the hurdles? Like, what do you see as like your next steps in like, getting into syndication?
Yeah, so a lot of it is networking with guys like you, finding people that I believe in, talking about some of the things that I think I do uniquely well, trying to see if I can get on some GPs, and trying to learn more about the good places to invest. Maybe partnering with someone that's a better fundraiser and or person that finds the deals than me. So those are some of the things. I'm just trying to put myself out there, meet guys like you, have good conversations, and then see if any type of partnership makes sense.
Yeah. Generally, on a GP, it gets sliced up. So Jay Scott put on a pretty phenomenal presentation on the costs, or like what it costs to fundraise and how to be compensated for fundraising at the Best Ever conference, which I highly recommend. It's probably the best ever syndication conference. But AJ and I and our team really enjoyed that, and specifically Jay Scott's presentation. It was really, really good. But the way that he kind of broke it up is that fundraising is roughly about 30% of the GP, asset management and including property management is about 40. Then you've got a key principal, which that person gets about 15 or 20%. And then the person who finds the deal, is getting somewhere between 5 and 10%. Those are pretty rough numbers, but the most of the money is being able to sign for the loan and putting, I guess, all of the people together and taking the asset management in-house. But that's something that we do. We do all of it, and you know, that's just kind of how we got started. We started syndicating on smaller properties that we could have bought ourselves, and we just brought in friends and family and like, hey, we were also like you who haven't lost money on a deal, and instead of reaping 100% return on that first deal, we screwed it up, messed up the loan, didn't return our investors cash, and we're going to make a little bit less money, but that allowed us to get into bigger deals. And so, from that point on, our investors are happy. Instead of us making money, they're making money. So, yeah. You also touched on kind of the underwriting standards, and basically what goes into underwriting, and essentially an appraisal, whether you're going to be able to have lower property management costs to increase your NOI to get a bigger value. Unfortunately, we've also tried to do that, and there are minimum limits with agency debt. And so, but I mean, there's always the opportunity to get that hard money loan or get a bridge loan and then get into that agency debt, which is a strategy that since the interest rates are so high and we're kind of like at the bottom, nearing the bottom of the cycle there's been a lot of record supply, a lot of deliveries here in Portland. I'm sure you guys are getting new apartments delivered.
Not really. Connecticut's super old, and we had an outflow of people for the last 20 years. All of our big businesses have left, so we have not really built in 20 years, which is a lot of the reason why we're seeing such an increase in prices. We're one of the few states in the nation that actually did not see a reduction in housing prices. We're up about 8% year over year, still, even with the interest rates going up like crazy. And so all of our building departments have like one guy. So there's really no significant development that's occurring in Connecticut. So that's another reason why I'm not syndicating in Connecticut. So,
but I mean, why wouldn't you want to syndicate in Connecticut?
I think that most of the properties that I would want to syndicate are traded off market. Usually it's to a Jewish community or other people that have held long term. A lot of the properties I would say are not actually even being traded. So if you look at the number of properties for sale, historically we're about 25,000 or so at this time of the year. We're currently at about 4,000. So stuff is just not trading. And also for me, we've seen such an increase in rent prices. I don't see that changing. I see rents going to continue to go up, at least in our market in Connecticut, 5% year over year for the foreseeable future. Like the numbers don't justify what people are buying housing for at this point in time. And so the only explanation that I have for it is that rents have to keep going up.
So I agree with you there. And so essentially, I mean, you're saying that prices are too high right now to jump in the market?
I'm saying prices are both too high and too low at the same point in time. Like I talked about is you can't build that property for that price, but you can't justify the purchase of the property based on the rents that you're going to receive tied to the interest rates and things like that. So they're trying to sell at like a 4 cap, a 5 cap when the interest rates are 7. You're not going to be able to survive your debt service, right? But if you had to rebuild that same building, it would be still probably 50% higher than it currently is. So you have this really weird situation where you can't bring on new inventory because you can't justify it in the building of property. At the same point in time, the rents have not gone up fast enough based on the changing dynamics in the rental markets. So we're kind of in this really weird place where I kind of want to buy, but I kind of want to sell, right? I want to sell because it's at an all-time high, but I kind of want to buy because I know that it's going to keep going up because we're not building and we can't build.
But who's going to buy it?
Well, so it's definitely interesting. There still are investors that are doing it. We're seeing a lot of sub 2. We're seeing a lot of those type of things in our markets. we also have situations where a lot of the 3 and 4 families are being purchased by FHA loans. I think there's going to be a lot of foreclosures in our market in the next 4 to 5 years, because if you're buying on an FHA loan on a 4 family, you're one heating system away, you're one roof away, you're one trashed unit away from not having enough money to continue to cover your debt.
Interesting. So two things there. So you mentioned that rents have to go up, but prices are high. So I guess one question is, what if somebody has to sell? Like, what if they really need to sell? And so I guess that's the point that I want to make, is that how do you find the people who need to sell, who are willing to I guess sacrifice a little bit on price?
Yeah, so like I have a business partner who's a wholesaler. He's selling flyers out all the time. I talk with every wholesaler in the state. They're canvassing all over, driving for dollars. Everything that's being done is being done in our state to be able to find those gems, right? We're currently in the process of flipping 2. Both we found off market. Both we're going to make a good return profile, but it's extremely difficult to find those opportunities in our market. I'm sure you guys are aware. I mean, everyone knows that the last 3 years, housing prices have gone up like crazy. So most people are not willing to take a haircut, even though the property is somewhat distressed, right? They're like, they think they have unrealistic expectations because of what they've been spoon fed for the last 3 years. And so it's a lot of that. And again, that's why we just don't have a lot of transactions occurring.
So, but I mean, it seems like those wouldn't be properties that you'd syndicate. So if you were looking at properties to syndicate, 10 plus units, north of 1.5, 1.8 million, like how do you get your foot in the door there?
So in Connecticut, I've strategically stated that I'm not going to buy in places that I feel unsafe providing property management services. So I said in the intro that my father had a property and it was in Hartford, Connecticut, and his tenant got shot and killed in the front yard. And so a lot of the quote unquote deals are in areas where I would call it D class, not even C class. So I'm fine managing C class and above, but if I have to wear a bulletproof vest on me, if I have to have a gun on me, it's not worth it to me. So those are where the quote unquote syndication deals are transacting. I have a buddy that bought a 100 unit plus building in Hartford, and he's doing well, but he's struggling because he's got a lot of vacancy issues. He's got a lot of tenant issues. For me, it's not worth it. All the other markets don't really have those type of high density buildings that were built. We were one of the first states in the nation to be founded. And so we have a very, very old, mature stock. The average age of houses in Connecticut is probably 1900s. And that's because that's what they say, around 1900, because they don't really know when it was built. We did have some additional houses that got built in the 1960s, but those were all ranch style single families after the wars where people were coming home. We really haven't had a building boom since then. So there's not really much syndication to be had that I'd want to do. And so that's where I would, partner with some guys like you, possibly participate on an LP, get my feet wet, learn a little bit, and then try to decide to go and syndicate somewhere else in maybe Texas or Florida.
Interesting. Yeah. So, I mean, is Hartford really that bad? Like the entire city?
Maybe not the entire city, but it's really area to area, and even with that, it's still transacting at, like you guys talked about, it could be transacting at 100 to 130 a unit, right? And the taxes. One of the interesting things about Hartford too is the single largest employer in the city of Hartford is the state. And one of the interesting things about the state is the state doesn't pay property tax. So all of these beautiful state buildings don't pay any property tax. So Hartford has one of the highest property taxes in the state. And our state property tax is already ridiculously high. So there's just a lot of reasons why I don't really want to go into Hartford. Some of it's financial too. So, but I could try to piece off those small areas that are worth looking at. But for me, for right now, like I would probably rather just go syndicate somewhere where the laws are more favorable to me. Someplace like Florida or Texas.
Cool.
Yeah. I mean, so there's the fund of fund models, which, where you'll essentially put together your contacts and your relationships and then raise funds. And essentially, if you raise enough funds, you can get into the GP. Otherwise, you can get kind of preferred shares of an LP, which seems like a great way to get your foot in the door.
Sure.
But you've got all this property management experience, so
no, and I'm sensitive to that.
That's
I
a great
guys.
asset. It's
sure.
We've just found out. Go ahead, AJ.
Well, I mean, even at BEC, just meeting other operators, there's a lot of guys toying with the idea of bringing the property management in-house. Like a lot of the pain points is with third-party managers is, they don't get real-time data. Like the story gets kind of muddled as it comes through. Like there's not great explanations as to why the revenues are not up. Like, that's kind of where I was getting at with the, idea of starting your own property management company is like you have a lot of control. Like you can talk directly to that employee. You can directly pull the reports. Like you can see what's going on. You can pull the leasing numbers off the self-showing lock boxes. Like you can just see what's going on a lot better. So the data that you get is more real time. And that helps with managing the asset like a lot better. And it helps identify issues and problems quicker. So you're not like at, 6 months down the line being like, shoot, we've had this problem for 6 months. Like you might be able to catch it in month 1, month 2, which can ultimately save a lot of money and help that asset perform a lot better.
Oh, sure. Yeah. What I will say, one thing, which I guess I didn't state before, most, if not most of the bigger syndicators or people that own the big buildings, they already self-manage, right? They've already built and established their own property management companies. And so, I'd have to.
That's the natural progression for a lot of syndicators is like they get out syndicating, they get in some other GPs, and then they realize like, oh, it's not money to be made on property management, but it's efficiencies that make the investments perform better. And you're going to get a larger benefit of return as a general partner, having the investments perform better, easier to raise money. Like it just makes a lot of things easier. So it's generally not like a vertical that people are like, oh, this is going to be a huge moneymaker. No, it's more of like, this is going to make the investment perform better. And ultimately that's going to be like, what is the best benefit to the syndication company?
Sure. There's
as well, there's plenty of other operators who are using third-party management who could absolutely benefit from, somebody who has expertise. And as well, I mean, the experience that you had with your brother, having him just show you exactly how to start up your property management company, like that is something that many syndicators can benefit from. And so I think that's just an incredible experience that you have and you can share.
Cool. Well, I think we're getting on towards time here. So we'll move to the last 4 questions, and I'll start the first one off, which is, what's one piece of advice you would give to your 25-year-old self?
What I would say is, like being an entrepreneur is amazing. I would say start earlier, quit your job sooner. When you're disenfranchised, quit earlier, and then get on this journey that you're on currently sooner.
Yeah. I love that. Okay. So what was your first entrepreneurial endeavor?
I sold candy in elementary school. I used to buy Airheads And I bought them, I think they're about 10 cents a piece, and I'd mark them up for a quarter a piece, and made a little bit extra money, and got in trouble because parents were asking their kids what they had for lunch. And instead of eating school lunch, they were eating candy, all candy. So that was my first entrepreneurial experience, was selling candy to elementary kids.
Jeez, you just forgot to have them sign the disclaimer.
I know. I got in trouble.
Yeah.
I did something similar. I would go off campus and bring pizza back on and then sell pizza.
Hey, at least there's the nutritional value in the bread and sauce. Mine, it was just straight sugar.
It's a fruit and a vegetable, isn't it?
There you go.
Tomatoes.
Yeah, tomatoes. Yeah.
Cool. All right. Next question. How has your formal and informal training shaped your journey?
So a lot. So my background's in engineering. I was both a nuclear engineer. I also have a physics degree. I worked on fusion and fission research prior to quitting and joining a property management company. So I'm very systematized, process focused to a fault, probably. And so that's really been very beneficial in the property management space.
Cool. Yeah, systems are huge. I mean, even when it just comes to running business. So whether it's property management or not, being able to be remote is all like systems.
Sure.
Okay. What last question. What was your biggest mistake and what did you learn?
Probably like I described, my biggest mistake was over analyzing the numbers on everything and not taking more risk. I'm by nature very risk averse, but it served me well. It continues to serve me well. But I think that if I was more like a traditional real estate investor back when I was doing it in 2012, 2013, 2014, I'd probably have twice as many properties. And so I think sometimes I'm a little bit too risk averse, and that's problematic when you're trying to be, making a lot of money in real estate.
Yeah. Well, thank you, Sam. If our listeners wanted to get a hold of you, how should they reach out?
Yeah, so you can email me. It's Sam, S-A-M, at ironcladpm.com, IRONCLAD, P as in Peter, M as in Mary.com. You can also call me directly. My phone number is 860-254-7343, 860-254-7343. Leave a message and I'll definitely call you back.
Awesome. Well, thank you so much for coming on the show and sharing your experience. It was great to hear.
Yeah.
Great. Thanks, AJ. Thanks, Chris. Appreciate it.
Yeah. Thanks, Sam.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on Win, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.